Right, so now let us look at individual candles. So how do you read individual Japanese candlesticks? So this is the chart that we saw in the first section. So this is the price, this is the time frame, and it's a daily chart. So each candle represents 1 day worth of price action. We will look into that. And it is a chart of Nifty 50. Okay, so it is an index. Now we have seen that the price has gone from in June, the price was 12,000. From June, it has gone to less than 11,000 by second week of August. So August starts here. So this is around first or second week. So as you can see in this chart, the price is going down. Now notice that in this chart, there are 3 types of candles. One is a bull candle, the bear candle, and the doji candle. So these are the 3 types of candles. So the bull candle means the price is going up on that day. For example, it's a daily candle, let's say. So this candle represents 1 day worth of price action. So white means a bull candle, black means a bear candle, and if there is no white or black color, it is called as a doji candle. Okay? So here if you see, this is a bear candle. So on that day, the price went from this point to this point. Then look at the rectangle, which is called as the real body. Okay? So that's a bear candle. Bull candle is, you look at this, whichever is a white candle is a bull candle. On that day, the price has went up. Okay? And then you see these small candles like this, and these are doji candles. Doji means, these are not perfect dojis because you still see some white color. So the price has actually gone up on that day. But it's a small real body. Okay? The rectangular part is called the real body. So it's a small body. That's why I call it a doji. Okay? That's all we need to understand for this. So now you can see what is happening here. If you combine the white, black, and the doji candles, you can see that sometimes the price go up, sometimes the prices go down, sometimes they remain flat. So consecutive bear candles here, so the price is falling. And if you look at this, how many bear candles here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 bear candles. And how many bull candles? 1, 2, 3 only. So out of 13, you have 10 bear candles and 3 bull candles. So that's why the price has gone down. So that's it for now. For now on, you only need to understand that black means bear candle, the price is going down. White means bull candle, the price is going up. And doji means it's a flat market. The price is neither gone up nor has it gone down. Okay? Now let us have a look at the market views, the players and the positions. So in the market, there are 2 creatures. One are the bulls and one are the bears. Okay? So the bulls are the one who are trying to push the price up. When a bull attacks, it is trying to attack by pushing the prey up. And when the bears attack, they are pushing their prey down. So when the bulls are the one who take the prices up, and the bears are the one who push the prices down. Okay? So in the market, there is a constant battle going on between the bulls and the bears. Okay? This battle or this price action is represented by Japanese candlesticks. That is what we need to understand here. So there are only 2 creatures in the market, the bulls and the bears. These are the market participants. At any given point in time, some people are saying that the price will go up, so they start buying. Some people think that the prices will go down, so they start selling. Okay? So that's the bulls and the bears. So because we have 2 players in the market, we have 5 market sentiments. Okay? The bullish, the bearish, the neutral to bullish, and the neutral to bearish. Now, what is this bullish? Bullish means you think that the market is going to go up, so you buy. and you expect to make a profit. So bullish view means you feel that the market is likely to go up. Bearish is the opposite. You feel that the market is likely to go down, so you sell. Neutral is where you feel that the market will remain flat. It will neither go up nor go down. Then there is something called as neutral to bullish. Now here you feel that the market is either likely to remain flat or it is likely to go down. But you know that there is a high probability that the market will not go down. Okay? And neutral to bearish is opposite of that. There is a high probability that the market will not go up. So it will either go flat or it will either go down. So what to do in this scenario? Okay, so if you're bullish, you take what is called as the long position. Okay, now in amateur traders, they say buy and sell. I don't want you to use the word buy and sell because I want you to use and learn technical terms now. So if you are a beginner trader and you are bullish, you say, I am taking a long position. You don't say I am buying in the market. You say I am taking a long position, because in the markets you can make money both ways. Whether it is going up, whether it is going down, you can make money both ways. So don't be under the impression that you can only make money when the market is going up. So if you take a long position and the market goes up, you make money, you make profits. Similarly, if you feel that the price is going down, you take a short position. And if the prices go down after you have taken a short position, then you make money. So understand that you have to use terms which are used by professional traders in the market. So if they're bearish, they take a short position and they make money when the prices go down. So if you're a bullish, you take a long position and you make money if the prices go up. So the opposite is also true, where if you've taken a long position, the market goes down, you will lose money. You have taken a short position, the market goes up, you will lose money. Okay? So there is a long position and there is a short position. If you feel that the market is going to remain flat, you don't take any position, you stay away from the market. Unless you are an options trader, which is an advanced concept we will not discuss here. There are also ways to make money when the market is flat, okay? So for professional traders, it doesn't matter whether the market is going up, down or flat. There are ways to make money using different financial instruments based on what is your view on the market, okay? So don't worry about that for now. For this course, you will look at Japanese candlesticks and how to take positions in the market. But understand that the more detail you go into the study of trading, you will understand that it doesn't matter where the market is going. You can make money any which ways. Okay, so there is long position for bullish view, short position for bearish view, and no position for neutral view. For neutral to bullish, obviously you don't take any position. Or if you feel that there are chances that the market will go up, and you take a long position. Same goes with neutral to bearish. Okay, either you take no position or you take a short position. So those are the 5 views of the market, or the 5 sentiments of the market. These 5 sentiments are nothing but the psychology of the market, as we mentioned before. You can form these views by looking at the Japanese candlestick patterns, which you are going to learn in this course. And once you have a correct view, then you know on which side of the market to trade from. Okay? Now let us have a look at the Japanese candlesticks anatomy. How exactly are these Japanese candlesticks created? What is the basic structure? So nothing complicated about this. So if you're a beginner, listen to this carefully. If you're already a trader and you've been trading for a long time, this is going to be very basic for you. So we looked at the 3 types of candles, the bull, the bear, and the doji. So if it's a white candle, it's a bull candle. If it's a black candle, it's a bear candle. Even if it has no color, it's called a doji candle. Okay, so those are the 3 types of candles, and this is what the candle interpretation is. So let's and look at the bull candle. So this is where the price opens. So this rectangle you see, this rectangle is called as the real body of the candle. This is the opening price. So let's say the price is opening at, for example, let's call it 100. Okay, so there is a stock which opens at 100 in the morning and it closes at, say, for example, 130. Let's write 130 here. Let's write 150 here. This is the highest price of that day. And let's write here, say 80. Okay. So we can say that in the morning when the market opened, it opened at 100. It went up to 150. That was the highest price attained on that day. And meanwhile, during the session, it also went to a bottom of 80. But by the time the market closed, the closing price was 130. So the market opened at 100, closed at 130. The highest price was 150 and the lowest price was 80. On that day, assuming this is a daily candle, so on this day, the price has fluctuated between 80 and 150. Now, usually that doesn't happen. So I'm just taking an example here. So this much price movement is unlikely, but just to show an example, this wick, this is called as an upper wick. This is called as the lower wick. They also call it lower shadow and the upper shadow. The distance between the high and the close that's the upper shadow. The upper shadow represents bearishness in the market because the bears are pushing the price from this point to this point. And the lower shadow, which is the distance between the lower shadow, which is the distance between the open and the low, it represents bullishness because the bulls are trying to push the price from this low level. So just to quickly summarize, this is the opening price, this is the closing price. That's the low price and that's the high price. So open, high, low and close. That's all there is to it. The rectangle is called as the real body and you have the upper shadow and the lower shadow. So there are only three components for a candle. The upper shadow, the real body and the lower shadow. Upper shadow represents the bearishness, lower shadow represents the bullishness. Understand that there is always heavy market activity at the opening and closing. So when the market opens, a lot of people are trying to jump into the market. And at the same time, a lot of people want to exit the market as soon as the market opens. So there's a lot of activity here. And same is the case with closing. Some people want to exit the market before it closes. Some people want to enter the market before it closes. So there is a lot of activity at closing as well. Now this candle, we said that it's a daily. It can be any time frame. It can be monthly. It can be weekly. It can be 10 minutes. It can be 15 minutes. It can be 1 hour, 2 hour, 3 hour, 4 hour, any time frame we can use this. So for example, if this is a weekly candle, then the range of this high and low is going to be very high. And the distance between the high and the low is called as the trading range of the market. So that's the range of trading on that particular week or that particular day. So that would be the opening price of the week, the closing price of the week, the highest price attained during that week and the lowest price attained during that week. Remember, for the bull candle, the opening is below and the closing is high. That is why it is called as a bull candle, because the price has opened here and closed above the opening. So that's why it is called as a bull candle. In a bear candle, you will see the opposite. The price opens here and closes below that. So that's why it becomes a black color candle, which is what we see here. It's the same analysis for the bear candle, but it's just that the opening and closing have flipped their positions. So it opens here, say for example 130, it opened at and closes at 100, and the high and the low remain the same. So that's the only difference, just the open and close have flipped their positions. So this indicates that the price is going down. Rest all analysis remains the same. and it can be any time frame candle. So now doji candle is very simple. By now you would have understood the opening and the closing are just the same. That is why it neither has any white color nor a black color. It has no real body. It is all about the upper shadow and the lower shadow here. So if we look at the upper shadow and the lower shadow, the bearishness of the upper shadow and the bullishness of the lower shadow keeps the price stagnant at that one level. So that's the basics of candlesticks. It's not very complicated. Go back and watch this video again if you are a very new trader. So now you can look at this same chart. We are looking at this for the fourth time now. This will help you analyze the prices now. The bull candle, the bear candle, the doji candle. You can also look at the shapes of the candles. For example, this bear candle is more stronger than this bear candle. This bull candle is more stronger than this bull candle. Okay? So there are different shapes of candles as well. So for now we are only looking at how the candlesticks are created and how the market chart is created for that particular index or stock. So this open high low close is just plotted on the y-axis, and this can be on that particular day. Okay? And it can be monthly, weekly, daily, 4-hourly, hourly, 5-minute, 10-minute, 15-minute. Even 1-minute charts we can have. So in this case, it's a daily chart. It can easily be a weekly or a monthly chart. It is going to look similar. It will not look the same because the price range will change. The shapes of the candles will change when you look at, if you convert this into a weekly. First of all, the number of candles will reduce because 5 daily candles represent 1 weekly candle. And 4 weekly candles represent 1 monthly candle. So the number of candles will reduce, the shape and everything will reduce. So, but all in all, it will look similar because these are all just candles, Japanese candles, okay? So we will have to go into more details to understand candlesticks even better ahead, okay? Alright, in the previous video, we looked at how the candlestick is created. Okay, it's not very complicated. You have the open, the high, the low, and the close. That's it. There is nothing complicated about that. You just have to understand the open, high, low, and close, and most importantly, what time frame the pattern, the candlestick pattern is representing. That's it. So these are all bull candles. Every candle is a white candle. But you look at the shapes here, okay? This candle is more powerful than this candle. It's more bullish than this candle because, as I mentioned before, the upper shadow, in this case, the distance from here to here, the upper shadow represents bearishness. So although this candle is a bull candle, there is some inbuilt bearishness in this. So that is why I call this more bullish than this candle. Now on this candle, the bullishness and the bearishness are almost equal. This length is almost equal to this, but the body is white. So that's a bull candle, but still with some kind of bearishness. This is a strong candle because it's open. There is no lower shadow, but the opening and closing has been very strong. The closing has been near the upper end of the trading range. Trading range, I told you, is the difference between the high and the low. So if the closing is near the trading range and the opening is near the low of the trading range and the closing is near the high of the trading range, that's a very powerful bull candle, okay? And this candle, it's a small real body. So that's the weakness of that candle. Although it's a bull candle, it doesn't tell us that the bulls are completely in charge of the market. Same goes with bearishness. So this candle, I think, would be the most bearish. If you compare this candle and this candle, the lower shadow of this candle represents bullishness. So there is some kind of inbuilt bullishness in this. But here it's clearly the bears are in charge of the market on this candle. Okay? So all of these are bear candles. On all of these days, the price has gone down, but there is a difference between the shapes of the real bodies of the candle. There is also a difference between the length of the upper shadows of these candles. There is also a difference between the lower shadows, length of the lower shadows of these candles. So depending on the shape of the real body, shape of the upper shadow, and shape of the lower shadow, the length of the upper and the lower shadow, we can have multiple permutation combination of candlestick lines. And these are the candlestick lines which we are going to analyze, and we are going to look at patterns which will give us more insights into the market. Okay?